Hello and welcome back to AM Trading. If you're new here, I'm glad you found us. In our previous video, we talked about understanding inducement in finance and trading. Today, we're diving deeper into the topic of liquidity and inducement traps, which are tactics used by market makers to manipulate traders. We'll be sharing insights on how to recognize these traps and make smarter decisions when trading. By understanding the inner workings of the market, you'll be better equipped to succeed in the long term. So if you're ready to take your trading to the next level, let's get started with part 2 of our series, Why 90% Fail with Smart Money Strategies and How to Succeed. Before we dive into identifying liquidity and inducement traps, it's important to first understand the difference between liquidity and inducements. The terms liquidity and inducement refer to two different ways in which market makers can influence traders' decisions. Inducement is a tactic used by market makers to entice traders into the market by making it seem like a good opportunity. Once traders enter the market, they may fall into traps that the market makers have already set up, which can result in significant losses. Unlike inducement, liquidity does not take traders in the market, instead it takes them out. Since we have covered the basics of inducements and liquidity, in the upcoming segment, I will provide practical guidance on how to incorporate inducement and liquidity into your trading strategy to avoid falling prey to market makers' traps and mitigate potential losses. In the figure presented, we can see a simulated representation of price movements. It indicates an uptrend, where the price mitigates a zone and then reverses to the upside. The price is pushed to the upside but couldn't break the recent structure. It makes a tiny pullback to the downside, gains momentum, and then pushes to the upside, breaking the structure. The unmitigated zone here potentially means that the price may get reversed from it. Another unmitigated zone is created by the recent break of structure. Inducements are placed on the chart designed by big smart money concept traders like central banks or large financial institutions to deceive or induce retail traders to have buy or sell positions in the market and eventually build more liquidity for them. For us, the zone shown in the figure is an inducement level, as the price tried to mitigate the lower zone but went up rapidly and broke the recent structure to the upside. In this scenario, the market makers induce some of the smart money concepts, ICT traders and retail traders to get into the market and have buy positions when the price is mitigating the inducement zone. The rejection makes most of the traders excited and makes them believe that the price will go in their direction. This rejection induces more price action traders to get into the market by opening buy positions with stop losses below the double bottom. This scenario designed by market makers has generated massive liquidity above the first unmitigated zone. As the market always sweeps the liquidity to gain momentum, the price comes back to our first unmitigated zone, sweeps the liquidity, and continues to its primary direction, which is the upside. Another simplified figure demonstrates a similar uptrend scenario where price creates a high and then goes up, causing a break of structure. We can easily spot the unmitigated zone and the double bottom acting as a support level. Retail traders enter the market by going long from the double bottom and expecting the price to push higher. However, the price didn't sweep the liquidity and continued to the upside after mitigating this zone. This shows how market makers and central banks manipulate the market to fall retail traders into traps, get them out of the market, and take their capital. Here's another example for the opposite direction. On the left side of the chart, it is apparent that the price is in a downtrend and has consistently respected this channel on multiple occasions. Following a lower low and overcoming an important bullish order block, the price changed direction and moved upwards towards the top line of the channel. This area can be considered as an inducement level, whereby many retail traders who trade based on chart patterns will enter the market through sell orders, creating a liquidity pool by setting their stop losses here. Market makers often aim to sweep the liquidity of the market, and in this scenario, they push the price to the upside, breaking the channel structure and trend line, hitting the stop losses of retail traders and gaining more momentum. Many retail traders aggressively entered the market by opening long positions, induced by both sell and buy positions. This scenario often repeats in the market, and it is precisely what market makers want. Following a pullback, some traders enter the market with the expectation of a price increase. The price continued to rise, making a temporary uptrend. But imbalances often needed to be mitigated, hence causing a drop to sweep the liquidity pool resting below the trend line, including the stop losses of retail traders who entered to buy positions within the temporary uptrend. After collecting liquidity from both buyers and sellers and mitigating this extreme demand zone, the price pushed upwards. Now let's move on to the real-life chart example. As evidenced by the price action, there was a change in direction to the downside following the creation of a change in character. The structure was broken with a close below the recent lower low, which was followed by another break of structure. It is now evident that the market is bearish. There are equal highs which indicate liquidity resting above, and an unmitigated order block generated by a boss. It is expected that price will hit and reverse from this zone, and sweep the liquidity that accumulated above equal highs before continuing to the downside. However, prices went up and reversed from this zone, and traders who attempted to trade from this level were incorrect, although lucky, as price eventually reversed from this zone and pushed lower. It is important to note that price always wants to sweep the liquidity, so anyone attempting to trade from this zone must acknowledge the liquidity zone created by recent equal lows. The unmitigated order block generated by recent boss is an inducement level. As based on smart money concept, this zone appears to be a good and safe level to go short because firstly it is unmitigated, and secondly price seems to respect this zone previously. Some traders who did not understand the concepts of liquidity and inducement were induced into the market and placed their sell orders in this area. Disregarding the liquidity zones that were resting on the chart, price pushed upside, sweeping the trendline liquidity created by retail traders' stop losses, as well as the liquidity of the inducement level created by SMC traders. After sweeping the liquidity of equal highs, price rapidly reversed to the downside. Thank you for joining us for part 2 of our series on liquidity and inducement traps in trading. We hope that you found the information we shared today useful in helping you make smarter trading decisions. Remember, understanding how the market works is key to success in the long term. If you haven't already, be sure to check out part 1 where we covered the basics of inducements in finance and trading. And don't forget to hit the subscribe button to stay up to date with our latest videos. Thanks again for watching, and we'll see you in the next one.